So it seems like we're getting a little bit of a repeat of what we saw a few weeks ago with a jump higher and especially the reflationary type trades and you saw here in the after hours especially GameStop going back up and a lot of those stocks that were associated with GameStop previously making more big runs to the upside. Last time that produced a really noisy move that was on the cusp of an intermediate pullback. Whether or not we'll get that again, I'm going to kind of break down what the charts are looking like and how likely we are to get any kind of noisy move that can exceed that, and what the cues are showing us in terms of what to expect. Because the cues are kind of on their own path right now and showing us different patterns that we need to be aware of to see whether or not they're going to extend themselves. The dollar as well is making potentially a pivotal move right now. So I'm going to show you what that is and its ramifications. We'll talk about the extreme moves that are going on, what's really driving the market here, what that means, what that means for our long-term expectations, and then today's trade idea will come out of that as well, benefiting from the current strong moves that we're seeing. So let's go ahead and get started. Today is Wednesday, February the 24th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. As you see, today we got as close as you could possibly. 79.04 on the near-term line over there on the left, 05. That's about as close to an overbought cluster that we could possibly get. Again, just about a week after the last overbought cluster we got. Very strong move off of yesterday's low point, pushed that momentum line to extreme highs, closing with another large range today with a high momentum line. The VIX isn't that high. Like, it's about as high as it was over here with all these small moves, or low, excuse me. The near-term line coming off of a bullish low point. So again, we did get that little bit of a red flag I mentioned to you before in our last video of the extreme momentum line though, but we didn't get that near-term line to also finish down in the oversold levels, which is the other half of that coin, of that short-term bearish short-term sentiment coin. Instead, we flipped that around and now we have a very strong momentum line, the strongest of this entire run. You can see, when you look at like intermediate rallies, you tend to get like really strong momentum moves at the beginning of these rallies, and there's a cluster right there and a few clusters as well. In fact, most every time that the momentum line gets to overbought levels, you tend to get clusters too, or really darn close. Like over here, that day, we also got a cluster. Oh yeah, that day we got a cluster there, and but over here, again, momentum lines without the intermediate line. And over here, when the intermediate line got into the upper reversal zone, we didn't get any momentum lines up to that high level. So it kind of gives you an idea that, when you get these high momentum, they typically are clusters, right? They typically show that we're pretty much done with that move, especially when we're 3 months, almost now 4 months into this intermediate rally we've been on. The Dow Jones Industrial Average did get the cluster, so we did get all 4 lines, which is different than over here. This is a beginning cluster, which tend to be pretty bullish, solidifies the trend. Now we're again multiple months, and you could say we ended the intermediate run there, but really didn't. We didn't get the dark pink shading and the red line combined for any kind of extended period. The Nasdaq didn't get it either. We were really at the lows of the day. We had the red line. But now the near-term line didn't get to oversold levels, hasn't this whole time, and again no cluster here because not nearly as bullish. And then the Russell 2000 didn't get a cluster because your intermediate line's not in the upper reversal zone. A good little bounce off of yesterday's long lower shadow that we had, and back to dark green shading and a green line. So don't have the dark green shading green line yet, but light pink shading and yellow line tends to be pretty bullish. And then the cluster there and really close to a cluster on the S&P 500. So needless to say, the trend's continuing. We haven't pushed up to new highs. We're still in, remember, any move between 0 and 23% up or down is just noise. You're either breaking the 0% and pushing up higher to new highs, or you're dropping down towards the 23% level, usually on near-term pullbacks, right? They're the ones that get to the 23% level, whereas once you get past that, that's where the intermediate pullbacks. And that's what makes the Nasdaq's so significant is yesterday we did break. We opened up down here below the 23% level. We got all the way down to the 38% retracement level and then rallied and closed back above the 23%. So no intermediate retracement here either, because it didn't close below the 23% level. So again, you can just see how noisy things can be when we're just trading on a closing basis, mind you, between the 0 and 23% retracement level. And again, we actually opened up back below it again this morning and closed back up above it. Even if we didn't quite get above the moving average, we closed back up above that 23% retracement. Again, closing price is what matters by far the most. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen, hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and that you want us to do another video again tomorrow. It's a quick way to give us feedback. If you like our videos and you want to let us know, click that thumbs up. If you don't like our videos, of course, you don't have to click on anything. You don't even have to watch the videos if you don't like them. Comment down there too. What did you get out of the videos today? What stood out to you? What questions or comments do you have? Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right here at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out some of these other things over here on the right, including our upcoming trading rooms that we have. Our Q&A sessions, you can see here, these are for our premium subscribers. But all of our monthly subscribers get access to all of our trading rooms, as well as our Market Outlook Live. Here's where I go through all existing Market Outlook trades that we've done in previous videos. We continue to trade them or manage them until we close them. And so this is where I will close them for all of you who follow me, follow those ideas as we put them on in these videos. These are the videos where I close them whenever I happen to do that. Come down here, click on this heart. It opens up a new tab. Hit this like button right there. Also click this thumbs up icon. Again, opens up another new tab. Hit that like button there as well. Again, the more you do that, the more people will see our content, so it helps us. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. And really quickly, for those of you who are premium subscribers that started out with us 3 years ago when we first started this venture that Brandon and I started, your subscriptions are coming up in June for renewal. We do have these discounts available for anybody who is renewing their subscription with us. You can see, for example, we have one more week left here for like 25% discount, which is actually better than our typical Black Friday discount that we give out on Black Friday in November, where we give out 20% discounts for our premium subscriptions. And then, of course, by the end of June, you still get a smaller discount. Of course, once the subscription expires on June 30th, then there won't be any discounts after that. You just renew just like anybody else who starts with us new again. All right, now let's take a look back at the 3 green arrow chart here, and you see that we do have, we had an increase in volume yesterday, still above average volume today with a pretty decent range, about 7 points. So as bullish as we were, that's not the most bullish range, especially like I said, when we don't have necessarily the big VIX spike to warrant bigger ranges. We did get back above the 8-day moving average just like that, so a big bounce. You can see the MACD histogram wasn't really too deep and it's rolled back up. The MACD itself actually is turned up here as the 8-day is expanding back away from the 17-day. So a good sign from that perspective. We've talked about the RSI and the CCI back above 60 RSI. We didn't get significantly below negative 100 on the CCI, so maintaining some bullish patterns there. The negative index didn't quite get back below 30 yet. At least it didn't spike up to high levels. That's when you really start to concern yourselves. In fact, if you notice, the Qs did, right? So that is the concern, that the Qs did spike up to high levels with the VIX, with the negative index jumping all the way above 40. The S&P didn't quite do that, so the ADX is still very low. If you look at the Qs, ADX for the Qs, you can see how much it's starting to ramp up because of that big jump that it had. But SPY pulling back down. We got above 30, but we didn't quite get below 20 on the positive index. Hence, the ADX is still really low and flat still. Finally, looking at like the Bollinger Bands for SPY, the bounce back up wasn't strong enough to say, okay, here we go again, right? Because we're not back into the upper quartile of the bandwidth. We're still kind of in this middle quartiles, middle two quartiles here, but at least we're on the upper half. So we're still bullish in that respect, and above the value area in the 1-year volume profile. So bullish in that respect as well still. Finally, one more thing I wanted to show you. So the trend strength indicator on SPY is still there. It's not very strong, but it's light. It's a weak strength, and we aren't back above this 65% level. We're not above that blue dotted line. So it's weak, but it's still bullish, right? Versus, again, the QQQ, where its trend got broken, right? We dropped below the blue line. We stayed below in fact, we're still below the blue line here today, or flirting with it. But at least, the very least, we're still above the cloud, even if that cloud is rising through the March expiration, and we wouldn't be if we end up staying flat from here. All right, now let's take a look at Now let's take a look at the intraday chart for the S&P 500. So we'll come down here and see that nice strong move off yesterday's low, getting back up to the top of this 4-week range. Not to a new high yet. We're still kind of flirting with this old high point, which I actually have to move this up. So it's up here. So we're not quite there yet, but still we're right at the top of the value area for the last 4 weeks. So we stayed in the value area. We didn't quite break below that 380 level, acted as a support, the midpoint of this 4-week range, which will be the midpoint for just about 4 more days before the midpoint now will come up to pretty much yesterday's low point. So that low tag, actually in another week, a little bit more than a week, that will be the low tag. So we'll kind of keep our eyes on that, because we did get the low tag over here on the Qs, not quite on the diamonds, and then obviously not quite on small caps either, but on the Qs we have. So to have the low tag on the right side of the high tag isn't necessarily the most bullish, and you notice we're headed up towards some resistance. We filled in the gap from yesterday morning. We filled in the gap from this morning, right? Neither one of these are necessarily significant gapping moves to the downside, as you see there. And then that's on the SPY. If you look at the QQQ, we got yesterday morning about a 1 standard deviation gap, but we didn't hold it, right? As you saw there with this drop, it's when you get a gap like that to the downside, you have to hold that gap, and you can see right off the bat we went in and filled a portion of it before filling in the rest of it by the end of the day. So not a quote-unquote runaway gap, even though that's still there from 222. It's not quite the same, but it's about, where is it? Nope. Here. No, sorry. Can't think of where I'm going right now. So, and then go to QQQ on this. It's not quite the same. It didn't quite get the 1 standard deviation. It got about as close as it could. Still about 1.5% decline, a gap to the downside, and then finishing down below 2%. So, if anything, if there's anything that's a runaway gap that doesn't get filled in immediately or anytime soon, then it would be what we saw not yesterday, but Monday morning. In fact, we've had 3 consecutive really significant down gaps on the NASDAQ. Kind of shows you where the weakness is at. And every time we've recovered, except for Monday, other time we've recovered, but then we gap down again. So let's keep our eyes tomorrow to see if this midpoint and this gap and this volume node here will hold for resistance, and we head back down below the value area in the 4-week range. And again, IWM can keep the markets bullish for a while, but can't necessarily trend them bullish for a long period. You kind of need the Qs, because that's where the market caps weightings are right now. So, these are the generals, so to speak, and the soldiers can help with no generals for a while, but eventually you kind of need that leadership to take hold. And as I said before, and I've shown you this chart before, let's see here, this chart right here. As I've shown you this chart before, eventually this will go up at some point in time, because not everything goes in one direction. There will be a move at some point in the other direction. Here's the daily chart there. And let's actually just go back to like a 1-year chart. There we go. So eventually this will move back to the upside, but right now we're just significantly bearish, but we are pretty significantly far away from the 30-day moving average here, which in the past has led to a move back towards the 30-day moving average, especially with the MACD as low as it is, and the CCI as low as it is, and the RSI getting to a relatively low level here, at least for this index in the recent past. Finally, let's take a look at the VIX and how it's been dropping here the last so many days. Last couple of days dropping back, from 25. That's why I say we didn't really get a jump in the volatility here. It was just a little blurb up to that 90% level. But now, as we pull back down, we're not pulling back down to these extreme lows yet, at least, which again suggests that it'll now be easier to get to the 90% mark. In fact, more likely the next level we'll test on the next bump in volatility will be the 95% mark. And then now once you're in that neutral range, it's easier to get up to 100 and 105% where intermediate pullbacks begin. So it won't go from extreme lows straight to 105%. It will work its way back up. And so we're, now you can see kind of like how we did here, where you came off of lows, you jumped up to 90%, but then you formed a higher low, then you jumped up to around the 95% mark, briefly went over it before coming back and testing the 90% mark, and then boom, again, about as close to an intermediate pullback as we could get there without actually getting one from a volatility standpoint. So I told you before that the range today was up about 8 points, so way higher than the average. The volume you saw was a little bit above average as well. So again, the more that these lines come up, that's not bullish. So if we're going to stay bullish like this, stay above the 8-day moving average, we're going to start having smaller ranges again, like in the 3 to 4 point range, because that's what happens when you're bullish, right? That's the kind of move we will expect to see at that point. All right, so as I said on Monday's video, as much as I didn't really buy into that selling on the markets, I expected that we would bounce up. We have bounced up, and now I do expect that we'll kind of stay and grind up. I still think we'll probably get another 1 or 2 near-term rallies heading into that March expiration before we finally really kind of overextend ourselves from an intermediate standpoint and start getting some kind of exhale, whether it's right at March expiration, maybe a little bit before, maybe a little after. That's probably going to be the time frame. So that would mean probably another 1 or 2 or 3 kind of shorter, more frequent near-term rallies, not your typical 7 to 12-day rallies. I think we're kind of done with those types of moves, and now we'll just get more frequent but smaller near-term runs where the near-term line might not get all the way in the upper reversal zone or stay up there for very long before pulling back down. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section down below, especially if you disagree. Let me know what charts or indicators you're looking at that would suggest why you're a lot more bullish than I am, or why you're a lot more bearish than I am. All right, now let's take a look at what's driving this price action. Look at the last, just the 3 days of this week. Look at that. You can even see it right there. But if you look at just the 3 days that we've had, it is a strong move higher in the inflation trade, I guess it would be the best way to say it. Commodities up 4%. Gold is up. The real estate prices are up 2%. The Qs are down. Emerging markets are down. Even though they wouldn't stay down too much in an inflationary environment. Long-term bonds are down along with, those are not two things you typically put together, the Qs and long-term bonds. But that's what happens in an inflationary environment. It puts a lot of pressure on those higher valuation stocks and allows some of these smaller cap companies to flourish and do a little bit better. In addition to your typical high-yielding assets, higher-yielding, the dividend-type assets. If you take a look at some of these different asset classes and how they look here. Let's take a look at the dollar relative to the euro first. And you can see we are flirting. Look at all the lines rising except for the market sentiment. We did pass through the market sentiment line. This is today's candle. This is obviously yesterday's candle. So we still, we're only a few hours into this one. But as of right now, we are breaking above the 23% retracement level. Now, keep in mind, we still got a long ways to go, right? This candle doesn't end until tomorrow, right around the U.S. market close. So a little bit afterwards, actually. So there's a long ways to go. And yesterday's candle, you can see, had a long lower shadow, or today's candle, excuse me, had a long lower shadow, and we closed right below. So it's very important to see how we end up closing here, and whether or not we stay. You can see the intermediate line got to the market sentiment line today, a little bit above it. It was at 75, and the market sentiment is at 61 right there. But now you can see it was the intermediate line's at 62, and the market sentiment line was at 62.91 versus 62.75. Obviously, now there's a pretty big gap today, but we're only a couple of hours into that. So obviously that can change if things turn around. So kind of keep an eye on this really important 23% level, because that will dictate whether or not the dollar is done with its little rally. It's kind of pullback rally that it's been on, or the drop that we've seen here in the euro US dollar. I mentioned the 10-year yield. One thing I wanted to bring up, and I tweeted this out for those of you who follow me on Twitter. This is significant to me on the 10-year yield. If you take a look, in the last quarter, we're up 67.5%. Let me kind of give you an idea of some perspective on that. And I talked about this in my class today, and unfortunately the recording had an issue. The recording had an issue here, so we weren't able to get, unfortunately, the recording for today's class. It's like the only recording I think we've had an issue with that I can remember in a while. Let's take a look at the max available on the weekly basis. You can see that the 10-year note going all the way back to the late 90s is all we have the data for on this chart. This is the highest quarterly return. We're not done. This is a weekly chart, so we still got 2 more days left of this to see where we finish. But in at the end of 2016, when Trump was elected, it got up to 57.5%, and then over here it got up to 60%. And right now we are at 67%, 62%. It looks like 65%. So that is an extremely high 13-week return, or 1 quarter return for the 10-year note. And as I mentioned, it's not the size, and 1.3 is not that big a deal. It's how fast we move. That's a fast move from extremely low levels to extremely, that moderated itself, got back to zero here for a while, up and down, but pretty much got back to zero, and then boom, we went up to extremely high levels. In the past, that's led to pretty sideways action in the yield for about a year. And in the past, it's actually been, you can see here, it actually led to a downward move in yields for the year later. Even if we did rally a little bit higher for a while after that, a year later we were down. But that didn't stop equity prices from going down. In fact, both of these years, the year later, equity prices had really good returns to the upside. So it's not bearish for stocks at all for yields to be this bullish. But it will be bearish for those types of stocks that benefit from higher inflationary expectations, specifically financials, energy, materials, industrials. They won't necessarily do the best, and we would expect that the dollar wouldn't do as well either, and the euro would continue its move, and the yields would kind of flatten out. So keep that in mind. That's an extreme high for the 10-year yield. And you would expect that, as we've seen in the past, it doesn't stay up this high for very long, and you would expect that it will moderate itself back down to zero relatively quickly, and generally over the next year typically has relatively low levels, as you can see. Going out a little bit further, again, that's nothing else is even close. Now keep in mind, the lower the yield gets, the bigger the moves will get, right? And right now we're about as low as you could get, and so you're getting extreme moves. But again, basically we've oscillated from one end of the spectrum to the other end of the spectrum. And when we've seen that done in the past, it usually just brings us back down to the mean, which right around this 20 to negative 20% is your typical range for how much the 10-year yield moves on a quarterly basis. The last thing I want to show you was commodities, which also have been making a really strong run. Again, over the last quarter, last 13 weeks, we're up 22%. That's a very strong rally in commodity prices. We saw that in 2016 and early 2016. You can see kind of went sideways for about a year after that move. We saw a spike in commodity prices that got up to about 20% there, almost 19.5%. Coming off of the 2008 lows, we had a big jump higher, about 25%, and then in 2008, when things went really parabolic, it also got up to 25%. So very, very high quarterly returns. And then when you look at the PPO here, the PPO, the long term, and how far up above that 200-day moving average, which we'll use the 40-day exponential as our proxy. Again, you can see we're about almost the 90th percentile. That's what gets you the green dots. But the only other time we've been more bullish than this was during this super cycle in commodities where we went parabolic. And you can see here we're pretty much going parabolic again. You can also see that as well on the RSI getting as high as it is on the daily chart and the divergence showing up there. But then again on the weekly chart, you notice we're getting above 80, which, as you see for commodities, let me go back on this particular ETF. The only other time we got above 80 was right there. Now it didn't go down immediately from there. We actually diverged up to a new high, like significantly diverged up to a new high. But see, that was a higher high. That peak on the RSI was a higher high on the CCI. It's not this go around. We're getting divergence setting up. So needless to say, both yields and commodities, which kind of go hand in hand with weakness in the dollar, right, and rising inflationary expectations, seem to be at extreme levels right now that are hard to trend from, right? It's not hard to keep going up from here, but these extreme levels tend to moderate some before we can resume longer term trends. All right, if we take a look at the sectors, and you can see how the strength right now of what's really been outperforming. In fact, again from really that 9/24 time frame where small cap started to really kill everybody, and this was actually last year, so 9/24 of last year up until now. 224, so we're looking at what, 5 months, 66% return in energy stocks, 44% returns in financial stocks. The S&P is up 21%, even though there was an up and a down move previously, because that's where the Qs kind of bottomed out, was there. Energy stocks didn't participate in the initial small cap rally. It's actually utilities and real estate that actually outperformed financials to a small degree. During the initial run right here, actually, from industrials, from that peak right there was utilities and real estate that initially surged higher. Then it was utilities, financials, energy, materials that led the second surge higher. So coming off of that low point where the Qs participated as well. And again, they're doing very, very well. Materials has had its run and then pulling back here, along with industrials had a run for a while, pulling back. Healthcare has been struggling, along with other safe haven and interest rate sensitive areas like XLU and real estate, staples down there too. But very, very strong moves in these two particular sectors that really benefit the most from inflationary expectations, because XLE is a good proxy for commodities as a whole, and then financials are a proxy for rising yields. And those are the two biggest, most extreme moves we're getting, and so they're benefiting those. But as you've seen in the past, when we get a spike in yields as fast as we've had, it tends to moderate over the next year. So that would put pressure on these particular sectors and benefit these those bigger areas like technology and discretionary services. And that's going to be your period of time where this comes back up, because I fully expect that this chart will come back up to these previous highs. Again, if you go back to those same levels, this is what I showed in the class today. If I go back to those same periods where we had in 2013 where we had a big jump in yields after good outperformance in small caps versus QQQ. Once we had that big spike in yields and we moderated for about a year, you can see Qs just took off against IWM. Same thing in the end of 2016. You had this big jump where the small caps really outperformed, and then from a year going forward, QQQ went, outperformed against small caps, got back up to its new old highs, got back up to its old highs, and eventually then some, and same thing over here. So past precedent shows that once yields start moderating, then you would expect this to get back to its old highs, which means you'll see these particular sectors start to underperform, maybe even come down because they have such strong gains to moderate and reconcile, and then you'll see some of these sectors over here start to outperform. Keep in mind that from a long-term basis, that's more of an intermediate expectation, because if you look at the long-term view here on the linear regression, SPY is at high levels, but look at energy stocks and they're not, right? They still have quite the room to run. So very, very small move, and financials are just barely getting above that one standard deviation. Everything else doing halfway decent. XLI is up there and materials is up there too, but energy just does not. So even if it is a little bullish right now and you'd expect that it will underperform, that will be short. You expect that this will get back up into the $77, $80 level, and then some going forward from here. That's why a lot of people have been looking at that, even up to its pre-COVID highs above 60, as an opportunity for directional trades, like we have in our older market outlook trades that we're still in right now, and some recent ones too that are in that reflationary trade. Even if we might, again, like I said, might be overbought in the short term, in the long term, we still have a lot of leg room to go here. So we had a really good day today, not surprisingly, in some of our directional trades in this video and also in our class trades that we've done. One trade I want to add to that list and be a little bit more directional in this too is Raytheon. So Raytheon's in that industrial area, getting a cluster today at the beginning of an intermediate rally. Market sentiment line still down low, so there's opportunity for that market sentiment to run. So it's a good overbought cluster at the beginning of intermediate moves tend to be pretty bullish, especially when the market sentiment line's got some room to run. You can see on a long-term crossover standpoint, Raytheon is kind of just getting started with this golden cross. We had the retest after the golden cross, and now we're back going again, so that's a good sign. Then you look at like its RSI and its CCI, and you can see the RSI is breaking out above 60, above 70. The CCI is breaking out to really strong levels. The DMI is moving higher, up above 30, down below 20. ADX is moving up close to crossing above 25. The trend strength indicator is crossing through its moderate strength levels above 2, above 65, making its way towards strong trending levels, which can be strong, as I mentioned before, for quite a while. So really, really good opportunities here here's the two-line version of Raytheon. You can see a nice good jump up in the MACD histogram and the bullish breakout above these recent highs. So a good opportunity for this stock to start making a trending move. You can see when you look at a longer term view, that pre-COVID high is its all-time high over here, and that's up to about 100, and we're just now at 78, 76 and kind of breaking through. There's a little bit of a volume node right there from Pack here, but you can see we have an opportunity to, once we get up through that, to really get going with very little volume all the way up to the pre-COVID highs. So that sets us up for looking at a long call option on this trade, looking at buying the $80 strike, which is your at the money right now, setting your, it's got the most extrinsic value, setting your stop order at half of that. So we've got about half a normal position size, with the idea that if it does get up to its highest levels, then we get about a little bit more than a 3-to-1 reward to risk ratio, and very easy to get out at our stop order because of we would have to be breaking. Basically, we're completely reversing today's breakout move. It's one thing to come back down to 75 because that's the level we just broke through and retest that. It's another thing to break back down below, say, 72, which would completely reverse the breakout. At that point, we'd probably get out and take, let our stop order get us out with that half a normal position size risk because of the speculative directional nature of the trade. All right, well, that does it for today. You've heard it from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there you'd like with any questions or comments you have about today's video. Reply to anybody else's threads. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon down below. Like our videos, as well as on Twitter and Facebook too. And then comment on anything that stood out to you. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.